Once again, good afternoon. Jeff Benson coming to you from Jacksonville, Florida. I am the program manager for Victor Builders Risk. This is another one of our webinars and our educational webinars. We like to think these are very educational. They're not just product driven. I always work a little product stuff into it, but for the most part, these are educational. And today we're going to talk about something that I get involved with literally every day, talking to agents time and time again. And it seems pretty basic, but to me, it's one of, if not the most important things that we do as agents trying to help our clients out. So today we're going to talk about, the pitfalls of underinsurance, but I like to think of it maybe, what's the limit? Let's decide how much should we write this coverage for. Now we are focused in on builder's risk, course of construction in the marine line of business. And it's a very broad line. I love it. We've done a number of these webinars, and then today, and they're all on the website. So today I'll probably refer you to a few for further information. So what we're going to do is go through the slide deck. It's not too many slides, and then we'll open it up for Q&A. Usually it takes 15, 20 minutes of material, and then we open it up for Q&A. So once again, really appreciate you taking the time today, and I think you'll find it very interesting. The pitfalls of inaccurate insurance to value. So before I start, I was doing a little reading yesterday, and I read a quote from a famous Oxford mathematician from the year 1621. His name was Robert Burton, and he was known to his famous quote was, "It's not right to be penny wise and pound foolish." We've all used that term a number of times. So if you think about that, I'm going to explain today why underinsurance is being penny wise and pound foolish. And I think it'll make sense as we go through the deck. At the end of the presentation, let me know if it made sense. How's that? So kind of starting at the beginning of this, I get asked this question all the time. Agents will say, why builder's risk? Why do we need this stuff? Well, sometimes it is a mandatory coverage. If you have a lending institution involved in a construction project, they're going to mandate that somebody carry builder's risk. When I say somebody, either the general contractor, the developer, the owner, someone has to carry builder's risk insurance, and they have to name the lending institution as a mortgagee or an additional insured. So it's going to be mandated. You really don't have a choice if there's a loan on the project. But today I'd like to take it a step further and say, even if there was no lending institution, even if it was someone or a corporate entity that is paying cash for a project, which now is very popular in residential construction, I could argue that it would be foolish, penny wise and pound foolish, to not carry builder's risk and coverage. So first of all, it protects all parties, or it can protect all parties that have a financial interest in the project. As I said, the general contractor, the subcontractors, the developer, the owner of the project can all be protected by a builder's risk policy. And in fact, if it's the right policy, they can all be protected on the same policy. So it's a pretty broad way of doing insurance. And the other thing too is this is going back to the same thing. So the premiums on builder's risk are a fraction of permanent property coverage. So if you think about what it would cost to insure a building that's standing there, and then think about what would it cost to construct to cover that building, why it's being built. So it's just a fraction. I'm going to explain why in a little while, but just keep in mind it's a the rates are very low, relatively speaking, on this coverage. Once again, foolish not to have the coverage and to have the right limit. It helps mitigate loss. Absolutely. I mean, we can get into this discussion. Does it eliminate loss? No, there's still the premium, I guess, is a financial impact because someone has to pay the premium, but it definitely helps to mitigate the loss. And that's another way of looking at it. And the last one is if you have proper insurance and it's, and the company adjusts the claim quickly and gets the payment quickly, we're not out too much time. And we all know time is money. So we can get this project back on time. So that's kind of what we're talking about today, builder's risk, course of construction. Now we're going to talk about what happens if the project is underinsured. Little story for you. I was sitting at my son's Little League game years ago, and I was listening to someone brag to the other parents about how cheap their auto insurance was. And I sat there and listened for a while, and then I asked him, I said, well, what's your limit? Like any of your limits, physical damage, comprehensive. He looked at me blankly, he goes, what does that matter? So that's why I like to say we as agents, professionals, we have to explain to our insureds, what is the importance of the proper limit and what is the proper limit. So we're going to spend the next few minutes on talking about that. But number one is if you don't have the proper limit on the policy, you run the risk of the insured becoming bankrupt or insolvent. We have a small custom builder building 5 houses a year. He has one of his projects severely underinsured, and that one burns down when it's 95% complete pending closing. He might be bankrupt if he doesn't have enough coverage on that. So you really don't want that on your conscience as an agent, I wouldn't think. The next one's kind of obvious. You are exposed to those two things we hate to talk about, errors and omissions for agents. So the insurer is going to say, you didn't explain this to me. I didn't know I could get this builder risk coverage. I didn't know I could get the proper limit for all these coverages. If you'd have told me that, I would have bought it. Of course, they're going to say that. So my advice to you, as always, is to document your conversations and put that in your proposal that you did go over all of this. And last, reputational damage for the insurance agent. We all want to be known as professionals. We want to know, we want to be able to tell people we know what we're talking about. We're going to help you. We're going to mitigate the loss. So I've had some agents that say, well, in order to save premium, can I just lower the limit? That's not the right answer. Okay, so the right answer is we need to insure it for the proper amount so everybody's fully insured. So hopefully we're getting somewhere on this topic now, I think. I get asked this question all the time. So what is included in the proper limit of insurance? We'll talk about hard cost. We throw these terms around in the construction industry a lot, but the brick and mortar cost, the brick and stick costs, it's all of the costs associated with the physical construction of the structure. It's something easier, labor and materials. You have labor and you have materials that go into all construction projects. It has to be related to that job site. So it's whatever goes into that particular structure or structures that are being built on that job site. So we know it has to include labor and materials. And the thing is, those are the easiest things to talk about when you sit down with a contractor, builder. He's going to know labor and material. Okay, I got that. I know what that is. So you start talking about that first. Then you're going to move into a few other more abstract type costs. And I just put this one here because it's the opposite of hard costs, and that would be soft cost. And we did a whole webinar on soft costs a while ago, and it's out on the website, and it's there for you, understanding soft costs. And so I'm not going to get into a lot of detail on that today, but it is the opposite of hard costs, let's say, and it's something you need to talk to your contractors about. I will say it's more of an optional coverage. They don't have to have it if they don't want, but once you explain it to them, I think they're going to want it. So just keep in mind, hard costs, soft costs, two different things. Here we go. Now we're going to get into the nuts and bolts of this. And I get asked this question just yesterday. I get it asked every day. So they'll say, Jeff, what's the proper limit? I don't know. What's the proper limit? The bank's saying you need X amount. All right, is that the proper limit? Maybe, maybe not. The bank's they're interested in protecting their interest. So what I'd like to say is I want to protect everybody's interest. So in that case, the bare minimum that you should ever write a builder's risk policy for is labor, materials, and overhead business expenses. Those first three are what I call absolutes, mandatory. Overhead can be a little tricky, but I've put down some examples here for you. Rent, administrative costs, utilities, sales and marketing, all of those kind of they're a little more abstract, but they're all factored in to the cost of building a structure. Profit is another interesting coverage. Now, I will say profit is optional, but in my mind, profit should be mandatory. So for example, we have a contractor that's going to build $1 million house. The $1 million house consists of labor, materials, overhead, and profit. He's going to make $100,000 on that $1 million house when he sells it. So let's just say that the builder's risk rate in your part of the country is 25 cents per 100 of value. So if you sat down with the builder and say, Mr. Custom Builder, I can insure your $100,000 profit you're going to make on the house if you build and sell it for a premium of $250. Now, I'd like to say any builder to say I'm not interested in that. So think about that for a second. That's where I said for a fraction of the cost, the rate's very low, you can insure their profit, what they're going to make when they sell it. So let's get a little more. I want to give you the next screen. I think if you walk away from anything today, hopefully you walk away with this. Estimation of completed value. If you remember this one little formula, we're never going to have a problem. How's that? Selling price minus the land value equals total completed value, or another way of saying equals the limit you should put on the policy. That is total completed value. And just a little explanation there. Our form, and most forms written today in Builder's Risk, are completed value forms. You write the policy in the beginning of the project for what the completed value is going to be when the project's completed. It's completed, they're pending closing, it's 100% done. That's what you want to write the policy for. So when you call me up next week and say, Jeff, what was that? I'm going to say selling price minus land value equals total completed value, or the proper limit you should put on the builder's risk policy. There you go. And the whole webinar for you guys was worth it just to hear that one little comment. How's that? So we're going to talk about my favorite friend, coinsurance. And sometimes I think a lot of agents get caught up in saying, I just want to avoid coinsurance. Yeah, of course you want to avoid the coinsurance penalty. But if you think about what I've been talking about all along, what is the completed value? Why would you want to have the right limit? It doesn't even involve coinsurance, because if you do that, you're never going to have a coinsurance problem. But once again, I'd be amiss if I didn't say that if you do underinsure something, you run the risk of becoming a co-insurer in the project, which would mean I say you as the agent, because if it's too bad of a penalty, that might be factored into your E&O policy, the E&O claim. But having said that, coinsurance did over what you should have times the loss. Now, every form has a little different nuance to coinsurance. Our form says if the claim is less than $25,000, coinsurance is not factored in. Just something that's built into our form. So you need to read each form and it'll tell you what it is. But the bottom line is, if you do the proper limit in the beginning, completed value, you never have to worry about coinsurance. I would say that's a good thing to not have to worry about. So that was kind of it in a nutshell as far as insurance to value and the proper limit. There's a couple of things that I want to talk about real quick though. So I do get asked the question a lot, not only what should I insure the project for, but how long should I insure it for? So I'm here to say today is, this is kind of silly, but I'd say you really need to sit down with your insured, the builder or the owner, and say, let's think about how long this is going to take. In today's world, with the shortage of skilled labor, a shortage of materials, we know projects are taking a little longer. So a general rule of thumb, and this is somewhat geographic because they build houses faster in certain parts of the country, but if you're building $1 million structure, it's going to take a minimum of 12 months. So why would you write a policy for 6 months if you know it's going to take 12 months? I would highly advise against that. If you're building a $2 million structure, it's probably going to take a minimum of 18 months, if not 24. So my advice to you is when you sit down in the beginning, don't try to be penny wise and pound foolish and write a short-term policy when you know it's going to take longer to build and sell that structure. Because the other thing is, here's what's happened in the world today. We have a 2-year project and you write it for 12 months. And at the end of 12 months, the underwriter that wrote it looks at it and goes, oh, I'm overexposed now in this coastal part of the country. I can't write this any longer. So now you have a project that's pretty far along. And I don't know if any of you have tried to place coverage on a structure that's been, pretty far along. It's hard to do. It can be very expensive. So it would have been much better in the beginning to write it for the accurate amount of time the project's going to take to build and sell. So just a little word to the wise. All right, the last screen before we open it up to Q&A would be our pass-through risk, and this is a little product driven for our product, Victor Builders Risk. We have pretty lenient guidelines as far as the business we want to write, as long as it meets certain characteristics. We call this the quote bind and issue experience. Should just take a few minutes. The basic code, construction, occupancy, protection, exposure, answer a few questions, hit a button, you're going to get a quote proposal, looks good, hit a button and get a policy. So that's the whole idea, is ease of doing business. So keep that in mind. And you'll see that one little thing is the project less than 30% complete. Hold that thought, because we're going to get to that, I think, in a little while. The ramifications of not placing coverage on a timely basis. So I think that kind of is it as far as what we're talking about today. So what I'd like to do now, Darcy, is open this up to questions and answers. And there's the contact information for Donna and myself. And there's the 800 number. Definitely call that if you have any questions. So Darcy, what do we got question-wise?
All right, Jeff. Real quick, right before we dive into questions, we do have a handout available to everyone under the handout tab with all of that information that we just showed for the V-squared pass-through risk guidance. So let's get on to questions. First question, why don't builders risk underwriters want to write a risk that is almost complete?
I actually got that question. I get that question frequently too. So the question is, what I talked about earlier. So the project is 75% complete, and then maybe the carrier that's on it now decides they want to get off of it for whatever reason. So they get off of it. Now you call your friendly builder's risk underwriter for XYZ Mutual, and they say, no, it's too far along, I don't want to insure it. You're like, well, what do you mean? So builder's risk coverage in completed value form, the rate is predicated on going from 0 amount at risk to 100% at risk over the course of time. So we charge a low rate and we collect a premium in the beginning, knowing that the exposure is going to be greater at the end, but we need to get that money up front. So if it's later on in the project, even if we go back to the inception of the project and charge the premium, we have lost that time of sitting on it. So the bottom line is, it's just not a very good deal for the risk taker, which is the carrier. And that was the whole premise of completed value. You're writing a policy not on what's at risk today, but what's going to be on risk, the completed value of the structure at the end of the project. So bottom line is, write it for the right term in the beginning and the right limit, and we'll never have a problem. So words of wisdom today. Good question.
All right, next question. You mentioned it's expensive to write a project that's already underway. Are we able to do so at Victor?
Ooh, I'm sorry, Darcy, I didn't catch that last part.
Sorry, Jeff, just saying, are we able to write projects that are already underway?
Yeah, so if you go back to that V-squared pass-through screen, it'll pass through if it's less than 30% complete, because we know these things happen. Sometimes the owner thought the builder was placing the coverage, builder thought the owner was placing coverage, and they didn't discover it for a little while. So up to 30% complete shouldn't be much of a problem. As it gets above 30%, then it's an underwriting hold, and at some point it's probably not something most underwriters would want to do. So the bottom line is, it's always best to write it in the beginning when they first start working on the project. I got asked that question the other day. Well, theoretically, labor is included. So if somebody's going to be clearing the lot and they're sitting on some kind of grading machine, that labor is part of the policy. So go ahead and start the policy then. You don't have to wait till a foundation or anything. The rough plumbing that goes from the main line to the house is covered. So the earlier the better, because we're not talking about, once again, go back to that penny wise and pound foolish. You're not saving them much if you wait to write the coverage. So good question.
All right. So going back to total completed value, is that the same as the replacement cost of the property?
All right, so let's think about this. So first of all, if it's ground up new construction, replacement cost, whatever, there's no depreciation, because what is replacement cost? Replacement cost is, like, kind, and quality. So if it's brand new construction with no depreciation, the completed value is the replacement cost. So, I mean, it's the same thing. So it shouldn't be If you do back to what I said, selling price minus land, there you go. That's what you should insure it for, and that is truly the replacement cost. Now, if you get involved in renovations and insuring existing structures, that's where it is actual cash value, replacement cost minus depreciation, or we do have an endorsement called a stated amount endorsement, which is a good way to insure existing structures. So we'll work with you on that. I think there's a webinar out there for that too. We talked about remodelers, but on ground up new, total completed value, replacement cost should be the same thing. Good question.
All right. So now, do you only write residential or will you write commercial?
For our program, it's based on value. So we do residential and small commercial. We can do up to 5 million frame, residential or commercial, and up to 10 million residential or commercial superior construction, M&C fire resistant. So it doesn't matter. Yes, we do commercial. It's about 30% of our business last time I checked.
All right. What is the longest term you will write due to delays of materials?
Well, our general rule of thumb is 2 years. But let's just say for COVID, materials, skilled labor, we might go over that a little bit. We'll take a look at it. You know, we want to take care of you. We know it's a little different times these days. Now, initially, when we write it, the most we will write it for is 2 years. If you have a bigger project, it's going to go beyond that. Give us a call. We'll talk about it. And that's kind of a general rule of thumb in the business for the small stuff. You know, that's about the time frame. Good question.
All right. Will you do a change order coverage?
Yeah, we have a change order, which is kind of interesting too, if you look at that. So they're building the house and somehow they've decided they want a different kind of marble countertop and it's going to increase the structure $50,000. So what I advise is all you have to do is increase it 50,000 right away. We're off and running. But if you want to, in the beginning, when you write the policy, you can add change order endorsement, and it's based in increments of 10, 20, or 30%. And so if that happens during the course of the project, it would be automatically covered. You wouldn't have to report it. So it's either way. The change, the premium is based on the same as if you had added it when you wrote the policy, or even as soon as you become aware of it. So it's kind of a sleep insurance. It's like a way if the builder forgets to tell you, oh yeah, we upgraded the appliances or the roofing materials. So yes, we do have a change order endorsement, and it's 3 options: 10, 20, or 30%.
All right. And now, if you're going off the selling price with materials increasing, labor increasing, and schedules changing, how do you handle, or how often do you increase the limit due to the increase in cost?
That's a really good question because it is going up. Now, first of all, I would sit down with my insured and say, you know, you're experiencing about a 10% inflationary rate now, so we need to build that into this and go ahead and write the policy for a little more than we think. That's number one. And that might depend on the quality of the construction, the part of the country you're in. But this is, once again, do not be penny wise and pound foolish. If you think it's going to go up 10%, then write it for 10% more than you think, or 20% or whatever it may be. I don't think, especially ground up new, if you overestimate a little bit, we don't really have a problem. You know, you're not talking about a lot of premium difference. And that would be number one. And I guess the change order endorsement, if that would make you feel good, you could do it that way too. Add the change order, and then if things go up in cost, it's automatically covered. You've already paid for it, but it's covered. Another way of looking at it. Good question.
All right. So is there any coverage difference depending on who places the builder's risk policy, for example, a general contractor or the builder?
No, I mean, our policy responds regardless of whether it's a general contractor or it could even be a subcontractor that's only insuring part of the structure, or it could be the owner. What I always suggest though is if you write the policy in the name of the general contractor, add the owner as an additional insured. It kind of makes it cleaner in the event of a claim. Property insurance is pretty interesting. It pays for people that have a financial interest in the house. Our form is very broad, so I think our form is one of the best out there for that. But either way, coverage is the coverage, the same for both. I will say our policy is designed to make sure all of the little nuances, coverages are needed for builders. Things like theft of building materials, whether they're attached to the structure or not. We have situations where maybe some appliances were delivered to the job site Friday afternoon. The project manager's there, so he goes, let's just stick them in the garage and lock them up. So they stick them in the garage and lock them up, and then something happens over the weekend and they're gone on Monday morning. They were never attached to the structure. They were just sitting in the garage. There are many forms out there that do not cover that theft. Ours does. It says theft of building materials, whether installed or meant to be installed. That one little wording makes a big difference. So keep in mind, there are many different forms out there. Good question.
All right, next question. Do you offer an escalation clause to bridge the gap for increased costs?
Yeah, we're really stuck on that one today too. So once again, I think the change order endorsement might be the way you guys want to go. Because basically it's saying, you know, we know the cost is going to go up during the course of construction, so you can buy it in 10, 20, or 30% increments. So if you're building $1 million home and you put the 10% change order in there, you got 10% more coverage in case something happens. Cost goes up. It's one way of doing it. And the other thing too is, let's just say halfway through the project, the builder recognizes this thing is going to be, you know, I'm going to sell it for a lot more. All he would have to do is call you. You know, he has to tell you why. But let's say he says, because of these things, it's going to cost more. I want to increase my coverage. You could call your underwriter and they would increase the coverage. Now, I will say, if it's $1 million structure and it's going to go up 100,000, that's not a problem. If it's $1 million structure and it's going to go up $1 million, the underwriter might say, I think you might have written this wrong in the beginning. So you just keep in mind, what is the difference? How much is it going up? So, but once again, I think communication with your underwriter is critical. And I know for us, all you'd have to do is pick up the phone and call us, and we would increase the value as long as you'd explain to us what's going on. That is one way of doing it. Good question.
All right. Next question. So one attendee has a prospect with many dwelling fire policies versus a builder's risk policy. Do you know why he would consider doing that instead of getting a builder's risk form?
First question I would ask, I guess, if it's an owner, and dwelling fire only covers the completed structure, so it wouldn't cover it as it's being built. So that would be number one. And number two is, if it's a builder, then they don't have, there's a lot of coverage that's missing. Interest of subcontractors, the building materials that are moving around the job site, all that stuff would not be covered. So, and even on the typical dwelling fire, it says, okay, if you're doing minor altercations, there might be coverage, but if they're doing major altercations, there probably is no coverage. So you just got to figure out, you know, if this is the owner and they're doing minor altercations, yeah, maybe. I still would write a builder's risk. I think it's better, it's a broader form. But if it's a contractor that's building things, they definitely do not want dwelling fire. There's too many holes in the coverage for them. We get asked a question about, well, what about a homeowner's policy instead of a builder's risk? We've even done webinars on that. So just be very careful, because a lot of homeowners policies do not respond to structures that are having major altercations done to them. It's almost like a different line of business. So good question.
All right, and we are at time. So if we did not answer your question, someone on Jeff's team or Jeff himself will be reaching out to you after the webinar. And thanks, Jeff, for all of your wisdom today.
Well, thank you, Darcy, and thanks everybody for attending. And let's write some business, and stay tuned for next month's webinar. We will let us know what you'd like to talk about too. And anytime you want to talk, there's the 800 number. Give me a call. I'm around. So everybody have a great day, and let's write some business. Take care.